So in this video, I'm going to be talking about Disney. Is it a buying opportunity? You can see the stock is at its 5-year low. Well, not quite. 5-year low would be like, I think, $79. Oh, wait, hold on. 52-week low is $78.73. So it's like $5 above its 52-week low. Um, and so it's, you could kind of say it's at its 52-week low. You can try to, like, if you wanted to buy it, you can say, oh, I'll try to wait for like a better price, which is a possibility. It's still volatile. The market is still in a downtrending position, and we could see lower prices on Walt Disney. But I don't. I'm looking at the finances, and I'm looking at you know everything, and I just don't see this as a really safe bet. Like, it's a well-known company, and it has very good franchises, but its fundamentals don't look that strong to me. So I wouldn't say it's a safe company to buy into, but and the rewards are not even that great, because if you think about it, right, its 52-week high is $184, and that's a double from these prices. A little bit more than a double. Is a double worth it if the possibility that you hold it long term and it actually gets pumped up to $186? I think it's like extremely overvalued at this point. Um, but is it worth it? Is it worth the risk? I don't know. It's up to you what you want to do. This is obviously moved by institutions because there's 183 million shares, so it goes up $5. That's $10 billion market cap to the upside, and as you can see, institution held by institution 65%. So an army of retail won't even move this thing like a dollar, maybe a dollar, but institutions are ultimately what moves the stock. So if the company performs well, if Bob Barker turns around the business, which doesn't even look that bad, honestly. I mean, if you look at his cash flow, making like, you know, 1.6 billion dollars of free cash flow. This quarter they had negative cash flow. So, annually they're making, know, this is 3 billion, this is 2 billion, this is 1 billion. Annually the cash flow is not even, but the operating cash flow is pretty nice. 6 billion, 5 billion. But one thing I don't really like about this company is its gross margin. Its gross margin is so bad, so bad. This is like 5-6% gross margin, gross profit. So I don't even know how they're even profitable. The operational expenses is like $5 billion, and their gross profit is 2.6 billion dollars. Maybe they get like a bunch of tax write offs that gets pushed back into profitability. But it kind of makes no sense because their operational expenses is more than their gross profit. So yeah, I don't know how they're profitable. Makes no sense. But according to the balance sheet, they're profitable, cash flow positive. No, operational cash flow is 2.8 billion. Free cash flow is 1.6. So, and then and if you look at the balance sheet, it's not that great, right? It's like, yeah, they're sitting at $11 billion of cash. Uh, I guess if you look at the current asset, it's $30 billion, and then you look at the debt, it's sitting at $47 billion. So they have more debt than the entire current asset. So that's why I wouldn't call it a safe company. They don't make very much money. They have more debt than cash. But they do pay a dividend, which is I thought they paid a dividend. I guess they don't. They did pay a dividend 5 years ago. Now they really stopped paying a dividend. So yeah, I don't know. I mean, at the end of the day, stocks are moved by institutions and hedge funds, and it's a gamble on if institutions and hedge funds want to move their stock into the upside. I don't have a position. I probably won't. But if it goes way lower, I might buy some just for fun. Hope big money pumps it. Anyways, thanks for watching and have a great day. Bye.